Good afternoon, everyone, and welcome to the Monday Open. My name is Mark. I'm one of the senior relationship managers here at Vantage Markets Australia. I'm based in Melbourne. We also have my colleague up there in Sydney. How you going, Jeff?
I'm good, Mark. How you doing, mate?
Good, mate. Good. So, a bit about what's going to happen today is me and Jeff are going to be discussing, what's happened in the markets last week, what's upcoming this week, a bit of Q&A, and some technical analysis towards the end. So, we'll start off with what's happened in the markets last week and also what's upcoming this week. I'll pass it over to you, Jeff.
All right, no worries, mate. That last week was a pretty interesting one. It was probably the busiest week for interesting market events for a long time. We had the Australian Reserve Bank leave interest rates here in Australia unchanged. That was as expected by virtually everyone. Markets get a bit jittery on the November move because it's on Melbourne Cup Day. That one saw the Aussie dollar firm a little bit on the news. I guess there were some people who had positioned the just in case trade, which was to sell the Aussie just in case they did cut, but that didn't eventuate. The statement that Michelle Bullock released after that, or the press conference, was certainly on the hawkish side, not on the dovish side. And as it stands right now, none of the big four Aussie banks are expecting a move in December. There is no meeting for the RBA in January, so that would leave February to be the next opportunity for the Reserve Bank to cut interest rates. And I think the futures markets are pricing in about a 25% chance of that happening. So, I mean, the market isn't overly exuberant about rate cuts here in Australia, which over the course of the week did help the Aussie dollar to outperform against most of the other currencies. We also had the UK Monetary Policy Committee cut their interest rates by 25 basis points. Again, that was as expected. That was, I think, the third or fourth chop in a row from the UK on their interest rates. Sterling had a little bit of a reaction to it, but I mean, it was the same day that Trump got announced as the president of the US. So, I mean, there were a lot of things other than that going on in the market, but Sterling has not had a really great time this month, has it, Mark?
Yeah, Sterling's been going sideways. Hasn't really made a decision yet as to where it wants to go.
Yeah, it's all about interest rate differentials, and they're both kind of cutting at the same time in more or less the same sort of momentum. So markets don't like that too much.
It's all about who cuts faster at the end of the day.
Excuse me. Yes. We also had the US presidential election with Donald Trump winning over there. That was broadly as expected. I think in the aftermath of the election, I was reading some news reports about that, and he had actually led every broad-based poll from the first week of October. So it wasn't a major surprise. What I did see that was interesting that I do want to keep an eye on for next time is that the betting market got every single state right. So they were completely 100% correct on every single state. He has ended up with the presidency, and the Republicans have won all the House. So it looks like he's going to have no problems passing his laws. And just remember, for all of those people who aren't a big fan of Donald Trump, he was president before and the world didn't end. Then finally, for last week, we had the US FOMC cut interest rates by 25 basis points the month before they did 50. So that's a bit of a tapering. The comments I've seen from the Fed members since that move have been fairly neutral to slightly hawkish, I think. They're waiting for inflation to come down a little bit more. They want to make sure that the jobs market there is still pretty robust and strong. They're certainly not talking the same kind of cycle that the UK is going through at the minute. I think for me, I think the risk is for the next meeting will be a bit of a pause. What do you reckon on that one, Mark?
I think a bit of a pause, yeah, and also I think that rates may even sort of like they drop down to 4% and just hold at that point, because with I mean, we'll probably talk about this later on, but with Trump's policies, it's seen to expand the US economy in terms of GDP, more labor, so it might actually cause some inflation, so which will, I guess, pressure the Fed to, I mean, even hike rates or even just remain the same for an extended period of time. So, yeah, see what happens.
I think, in a nutshell, those of you who are expecting rates to go down to COVID levels again will be probably disappointed everywhere in the world. I mean, it's a different time. We don't
Yeah.
have a global pandemic, and the economy is actually doing reasonably well globally. And we do have inflation that we need to kick. So that was last week. The big key events for this week, we've got US consumer prices coming out on Wednesday. That will be a really well watched data event for the entire market, because the markets will be looking to that data to signal what the Fed might do at their next meeting. Um, my view is that it might come a little bit firmer than expected. I'm of the camp that we haven't completely broken the back of inflation, to use Paul Keating's words. I think inflation is going to come back, and I think it's going to come back hard. Excuse me. So it will be interesting to see how that plays out. Um, Usually, I guess in my head, every month it's the US non-farm payrolls that are the most important data release. But I think increasingly, certainly between now and the end of Q1, it's going to be these inflation numbers that's important in the States. We will also have, or we will have on Thursday, the Australian employment number. That was quite soft last month, so expect a rebound there. Also, have a look for if you're a market nerd like myself. Have a look to see if there are any revisions to numbers. Normally, when a market moves in what common sense would say is the incorrect decision based on a data release, it's because of revisions to previous numbers and previous months. So I think there might be a revision to last month to be a little bit firmer than what it was, because it was pretty soft. And finally, on Friday, we're going to have the US retail sales numbers. The retailer has been pretty strong globally, I think, despite the fact that China is slowing down and could even actually be in a recession. I think the retail sector has still been really quite strong just globally. Even in the UK and the US, just, people are still spending. So that was the focus for this week. Mark, did you want to talk about technicals?
Sure, I'll just quickly share my screen. So we'll be going through pound USD today, euro USD, and a bit of gold. So I'll just quickly share my screen. Can you see that, Jeff?
Yes.
All right, perfect. So we have here 4-hour chart, pound USD. You can see here price was trickling down, making a series of lower highs and lower lows. So you can see here downtrend, and it's just been trending ever since. So we have the upper range here of 130.48, 130.32, lower range here 1.2834, 1.2864. Obviously here we had stronger dollar on the back of the US elections. We did bounce from this area, and yeah, price has just been ranging ever since. So not much on the pound. I mean, the Bank of England are still expected to cut rates, depending if inflation numbers do surprise them to the lower side, then they may even cut rates even more aggressive. But overall, yeah, this pair's under pressure given the recent US dollar strength and sterling weakness. We'll go on now to the Euro USD. So again, here dollar strength on the back of the US elections. We did see Euro dollar break this trend line, which has been intact ever since April here. So nice break there. What's interesting is we've come back and sort of retested this area here. The 50 EMA price has reacted, and it's pushed down to this level here. We can even draw in a Fibonacci retracement from the high there to the low. So these Fibonacci retracement tools are used to measure the ratio of the move. So for example, if you want to take this leg of the move, which I just did now, so you draw it from the top here to the bottom, it gives you sort of a retracement move. So here we got to 50%, which is saying that it's come down, retraced about 50% of this move here. So you can see it's reacted off this level. We've pushed down to this support area here, 1.0683, and now price is sort of just hanging around there. You could even use what is called the Fibonacci extension tool as well, which measures the extended move. So if you want to take it, say for example, from this high there to this low and back up to the high there, you can see the extension levels here: 127, 1414, and 1.68. So if you were short around these levels, for example, you want to you've had two targets. Say you want to take an extended target, then Fibonacci extensions are used for targets. So you can see here the 127 lines up with this structure here. So it's just a tool that you can use, to predict your profit taking targets or even stop losses as well. But overall, again, this pair under pressure, dollar strength. Even the European economy is slowing down as well. I mean, it might get a bit worse with the policies that are upcoming, but let's see what happens. So moving on to gold now. Very similar to the euro dollar setup in terms of we breaking the trend line, coming back up to retest that area here. So you can see more clearly on the 4-hour chart. So we've broken that trend line here. We've come back up, retested this area here, which was also a support level in the past. So we've come back up, retested that area here, which was previous support, and now this turned into resistance, trading below that EMA there. Yeah, so I mean, it's a similar move to the euro dollar. You could even put in a Fibonacci retracement here as well. That's around the 0.382 retracement. And if you want to draw the extension from here to here, if you were to have multiple targets, then these will be the options here. 127 lines up with this. So there's many ways you can approach it, but overall with gold, I mean, like if you look at the weekly, for example, we've seen. I'll just get rid of these to make it more clearer. So you can see here, it's just overbought. I wouldn't be surprised if we sort of had a correction here on the weekly chart, possibly to even these levels here closer to this EMA, and we got here a bit of sort of a psychological lever here where prices act as resistance and may even sort of act as support. So we got a bit of a drop if it does move, but it is under pressure given dollar strength at the moment. That's about all for today for the technicals. I'll pass it over to Jeff now to cover the question and answers.
All right, no worries. Just before we do that, I think it's interesting that Fibonacci can tend to work on certain markets more than others, and it seems to work better on the more liquid markets. I've found with my experience that it works best on gold, dollar euro, and dollar yen, just because they're kind of the most liquid. The golden mean tends to work when there are more people participating in the actual market itself. But let's scream through these questions. Question one, I'll look after that one, Mark. These are questions that we get from clients that we speak to during the week, and sometimes the questions are just a little bit topical or particularly interesting, and we like to share them with a broader audience. Question one for this week is, what is the difference between CFDs and futures? This one used to come up a lot more in the old days, but people seem to have forgotten that futures exist. Futures and CFDs are very, very similar, and I would argue that CFDs were actually a product that was based off futures. Futures are traded on an exchange, so locally here we would have had the Sydney Futures Exchange, or in our region we would have had Cymex, the Singapore Exchange. They were the two big ones here in Asia. And futures have settlement, so futures will settle whether it's every quarter for a financial future, or it could be monthly or bi-monthly for agricultural futures, whereas CFDs don't, except if they're a CFD over a future, in which case there's a little bit of a gap on the roll. So that was a question I think that we answered last week or the week before about roll gaps. Roll gaps only really occur on CFDs with futures. Did you want to look after number two?
Yeah, sure. So question 2, we often get this from clients actually. So can you outline some basic risk management ideas? So with this one here, there's no right answer. So the thing about risk management is you want to sort of come up with an approach that sort of fits your risk tolerance. So to give you an example, you can have like a trade, for example, with a 2-to-1 risk reward ratio, and yeah, and the way you look at it is like, what's my results after a series of say 20 to 30 trades, not like what this particular trade is going to do. You got to sort of see a result after 30 trades. A lot of clients say they target sort of daily targets, which I think is not the best idea, because some days you might get losing days, might get winning days after that. But at the end of the day, it's all about just where you're at after 30 trades. That's the way to sort of measure it. A good rule of thumb in terms of risk management, I mean, anywhere between 1 to 5% per trade. Obviously, the 5% being more on the aggressive side, 1% being more on the conservative side. But there's many ways you could sort of structure it. You could even have like 2 separate targets: target 1, 1-to-1; target 2, for example, 2-to-1. Once target 1 is hit, for example, you could even go break evens on the second target just to mitigate that risk. So it's yeah, there's no sort of right answer for this. You've got to sort of experiment, I guess. And yeah, at the end of the day, don't focus on each individual outcome of a trade. Focus on where you're at after a series of trades. That's really the key factor here.
All right, good tips. Good tips. And I'm with you. I think that risk management is a very personal thing. And I really don't think there's a defined right or wrong answer. On that note, I think there's a very, very good book called Trading for a Living by Carl Van Tharp, which is pretty much the entire book is about risk management and trading systems in risk management. It's one of the ones that I like to say for my clients to have a look out for. That's about it for that one. Is that it for today, Mark, or is there anything else that you wanted to add?
Oh no, that's pretty much all.
All right, good. Well, look, just while I've got everyone here, I wanted to send a personal hello to Brenda, who is one of my clients, who is a avid watcher of this particular webinar. Hey, Brenda. For those of you who do want to get a little bit more engaged with us, our team, we have a VIP trading room, which is staffed by us. Mark and I are logged into that all day long. And it's kind of the cornerstone of a lot of the content that we do. It's also staffed by some analysts from the Everest Fortune Group. Those guys are Southeast Asian-based analysts who work very closely in the hedge fund space. They can provide some analysis for our clients, and they also can answer questions. This particular webinar will be uploaded to that trading room on its completion, and it will also be uploaded to our YouTube channel. Also, within that trading room, we have our weekly technical video that is uploaded every Monday. And finally, Mark and I write the private client daily update every morning, which is a wrap up of the nights before and the upcoming trading sessions. That goes out as an email blast to people who want to be emailed it, and it is also uploaded to the trading room. Excuse me. If you haven't noticed, if you haven't looked at the trading room, you really probably should, because there's a lot of content there. And if you want to get in touch with Mark or I and don't want to pick up the phone, that's a pretty good place to do that too. So thank you very much, Mark. I'll see you next week.
See you next week, Jeff.